Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. S&P 500 hovering right around 50.85. Selling off a little bit today, but I would remind everybody we're right about 1% off the all-time high for that particular index, and up about 7.3% year to date. So might be having a little bit of a rough day today, but just in the spirit of, how are we doing overall? Index doing very, very well. That's being driven really by two different things. One, it is the end of earnings season. We got a relatively positive earnings season this year, which we'll dive into the numbers through. And then second, a little bit more comfort on Fed speak and what's going on in the Fed. So we'll touch those both in turn. Meanwhile, I also just want to point out that the 10-year Treasury is currently right at about 4.15%. And that is down about 20 basis points, about 0.2%. Since the highs a couple weeks ago, which is kind of an indication of the Treasury market starting to normalize a little bit, that interest rates might not be moving higher. And I, for one, interpret that as a very, very positive sign. If we think about the path of 10-year Treasuries, we were all the way up at 5%. We dropped down as low as 4, a little sub 4% actually. And then had creeped back up to 4.25, which is the bond market telling you, hey, we might not be out of this interest rate picture yet. And so the recent move in the bond market a little bit lower is actually a positive sign as it relates to inflation and growth in the rest of the market. So earnings season has wrapped for the fourth quarter. Earnings coming in right at about plus 7.8% year over year. Revenues coming in at plus 3.9% year over year. That's versus consensus on earnings of about 2%. So we were about call it about 5.5% higher on earnings than we thought we were going to be. And that is enough to sort of push us in the camp of, that was pretty good earnings season. And I think that's some of the reason for a lot of optimism within stocks, particularly over the past week and a half. Saw a number of these companies towards the tail end of earnings season that came out with stronger than expected numbers. And that really has fueled a decent amount of the market rally. On the other side of that market rally, you have a number of the Fed speakers coming out this week offering talks. And I would just say that the overarching phrase coming out of the Fed is longer for longer. We've been at about 5.25 now since late last year. I think that as you listen to Fed speak, the Fed is going to be very, very clear that they want to be convinced that the inflation numbers are actually headed in the right direction before they start to ease or maybe put on the brakes at all. And certainly some of the recent data that we've seen on inflation has been a little bit more mixed. And so I think the Fed very clearly communicating to the market to say, look, economy continues to grow, earnings continue to be good, unemployment continues to be low. We're not in any hurry here to move those interest rates lower. In fact, we've got a little bit of time, the strength of the economy continuing to sort of propel us along. So as opposed to maybe easing too soon and letting that inflation genie out of the bottle, we're going to make sure that that genie is all the way firmly inside the bottle before we start to, ease any of the pressure that's on the economy. So I think you're going to see that, continue to hear that. We saw one of the Fed members out earlier this week sort of commenting that maybe it's only 2 cuts this year. The market gradually coming around to this view on the forward interest rate curve of, longer, higher for longer interest rates. And I think that's a good thing. It's a good thing in the face of economic strength. We'd much rather see the Fed feeling comfortable leaving the brakes on, given the underlying strength of the economy, than the Fed being in sort of a nervous panic to try and move to stimulate, sooner rather than later. So with that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. Hope you're having a great day, and I look forward to talking to you again soon.